Supply and demand is clearly the most profitable strategy out there that has remained the same year in, year out. But then a lot of people still find it really hard trading supply and demand because they often identify zones that actually fail. Well, in this particular video, I'm going to share with you exactly how you can trade supply and demand with a mixture of what we call liquidity. So liquidity is something that is very important for everyone to identify whenever they are trading supply and demand. And if you are able to identify where there's a liquidity in the market, then trading supply and demand will become pretty much easy and then will keep you more profitable. So with this already said, and without taking much of your time, if this is your first time on the channel, do help to smash that subscribe button, as this channel mainly focus on sharing videos on how you and I can actually trade and make money from trading. So with this already said, and without taking much of your time, let's get straight on my computer. Let me share with you a step-by-step guide on how you can actually trade supply and demand and also identify liquidity zones in order to help you enter the market at the safest point. So let's get straight into today's video. So hello guys, now that you're on my laptop, now let's get straight into today's video. Let me share with you everything you need to know in order to trade supply and demand plus liquidity more profitably, because with the idea of liquidity in addition to it, it will give you a decent trade that with less risk and more winning probabilities. Now here's some backtesting I actually did on this strategy. I took a total of for the past 12 days, which is from July 19th to today that I'm recording this video, July 29th, which is 11 p.m. I've actually taken a total of 20 some, is it 24? It should be 22 or more backtesting. So let me just copy it and see how many. So I've had a total of 22 backtesting, and out of this 22 backtesting, if I'm not wrong, I have won more than I lost. Now let me look at the ones that I've won. I won a total of 16, and then I lose out on 5. That's a good win rate. And then I missed 1. So out of 22 trades, I missed 1, meaning I didn't take that one. I took 21, and out of those 21, I won 16, and those 16 were only won based on patience and applying the rules that I'm going to share with you. And then I lost at 5, and those 5 were lost by following all the trading rules as well. So you need to understand that over here there's winning and losing. So let me give you a typical example. So this is a typical example of this strategy. You can see over here illustrated here, and then also here. So when I'm back testing, I actually take screenshot of my trades and everything, so that whenever I look at the picture again, I know exactly every single thing I did on there. Now here's it. The strategy is simple. The first one is simply identify the market direction using the daily time frame to the 1 hour time frame. So the rule number 1 says what? Identify the market direction. Now when identifying the market direction, the time frame you use is important, and the reason why we need to use daily, 4 hour and 1 hour is simply because the higher the time frame, the better view of the market you actually get. Now taking a look at this market right now, if I show you this market right now, what will you tell me this market is doing? Obviously, even a newbie trader is going to tell me that, well, this market is a downtrend. But then let me shock you. Coming over to the daily time frame, let's take a look at the market. On the daily time frame, what do you see? We have a clear uptrend. Because we have a clear uptrend on the daily time frame. This shows that what is more safer to looking for a buying opportunity than selling opportunity. This is the reason why whenever I'm analyzing my market, I always look at the daily time frame before any other time frame. So the maximum I use is I use the monthly, weekly, and daily. But in most scenarios, I pay more attention to the daily, 4 hour, and 1 hour, because I'm not here to hold trades till thy kingdom come. So now on the daily time frame, we can clearly see that the market is in an uptrend. The next will come over to the 4 hour time frame. Now on the 4 hour time frame, we are mainly after looking at the key areas that the market has created whilst trending upwards. Now over here, we can see that what we have a very strong, you can see we have a very strong support level here. We have a strong support level here, and over here we have what we call a market shift. You can see over here the market was giving us the downtrend vibes. It was giving us a downtrend vibe, but it eventually cut out of it. So over here we have what we call market shift. Some call it change of character. Some call it change of character. Some call it break of structure. But to me, I call it market shift. And okay, some call it change of character. And then the continuation is a break of structure. So for me, I just see it as market shift. So over here we have what we call the market shift. I already have the shortcuts down there. Market shift. Over here we have our break of structure. Now the reason why you need to identify this as a newbie who is trading this system is that you need to identify this change of character or market shift and then the break of structures, because they will help you know which direction the market is going to. Because the more of them you identify, the more you see the new direction that the market is actually heading to. So now you see at every point whereby you get a pullback, you identify it. So this shows that what we are still in an uptrend. Now, the only time whereby you can consider this market to be a downtrend is simply when this market has actually taken out two consecutive break of structures. So you see that here we have two break of structures here. By the time this market actually successfully pull from here up to this level here, which is lower than this area here, then we can consider that the market is no more an uptrend again, but a downtrend. But since the 4-hour time frame is showing us that the market is still respecting this area here, that shows that what we are seeing an uptrend, so we should be more of looking for a buy opportunity. So now for that, after identifying this, we know that we have a support area here, so you can just mark it down if you don't mind. For me, I mostly don't mark it down. Once I see it, I just remove it. Now after identifying this, now we know the market direction, that the market is an uptrend. We've seen that the market pull back to a previous area of support and then bounce off it immediately. Now the next thing we need to do is that we need to identify what we call our supply and demand levels. So in the case of buying opportunity, if we are looking for a buying opportunity, then we are identifying what we call the demand levels, which is areas whereby people are interested in buying the market. Now for that, let me just come over here to read. The second rule says that identify your supply and demand levels. Now here are the rules. Your supply or demand level shouldn't be tapped. Simply means that what, after the first bullish candle, the first two bullish candles that came after the red one, because the red candle is what we are going to use to identify our demand level. So after that red candle, the next two bullish candle that is coming there, after those two green candle has appeared, let no any other candle comes back to retest the area. Because if another bearish candle comes back to retest the area, it simply means that what, the area is no longer a valid demand level anymore. And that is the first rule. The second rule is that what, candles not overtaking directional candles. So what the directional candles means is that in case of identifying a demand level, your directional candles are your bullish candle, because that is the direction you want to trade to, you want to buy. So when you are buying, your bullish candles are your directional candle. Make sure that the red candle, which is the bearish candle that you are marking to identify your demand level, is not bigger than the bullish one that came after it. Now let me show you a typical example of what I mean by that rule. So for example, let's take a closer look at let me look at one typical example here, if we can spot one here. Okay, so here we have one. Let me just zoom into it. Take a look at this area here. Looking at this area here, we'll say we don't have a valid, you can see, take a look at this area here. You can see that the bearish candle is bigger than even the next two bullish candles combined. In this scenario, this is not a valid bearish candle to identify a demand level. But if you look backward here, like take a look at this candle here, this one is a valid candle for you to identify. Why? Because it's not bigger than the bullish candle that came after it. But now the market has tapped into it, so it's no longer a valid zone as well. Now that aside, let's take a look at another typical example here again, if we can find more. Here is another valid demand level, because no any other candle has come in, and this red candle is not bigger than the green that came after it. So now you can keep on identifying more and more. Here's another valid demand level here. You see, they are very easy to spot in the chart. This one is not a valid one because this red candle is bigger than the green that came here. So now this is simply the idea of identifying supply and demand levels. Look for the areas that the market push out from massively, not some tiny areas. Like for example, looking for a demand level inside here is not really reasonable, because let me say, when the market was halfway here, then you mark here as a demand level. Getting a demand level here is not really that reasonable, because what, it's not really a strong. So you can see after the 1-2, boom, market came back into it again. So now let's just leave all of this and focus on the current market movement. Now that's simply what you look at for when identifying your supply and demand levels. So now over here, we are looking for to identify our demand level. If you look at here right now, this candle here obeyed our rule of actually identifying a demand level. But note, we will identify our demand levels on the 1 hour time frame and not the 4 hour. The reason is that if you identify it on the 4 hour time frame, your stop loss is actually going to be really huge, but the 1 hour will actually help you narrow it down. That's why we'll be using the 1 hour to identify our zones. So now I believe you understand the idea of make sure that the zone, no any other candle has tapped into it, and make sure that what the red candle, the bearish candle is not bigger than the bullish candle. So now for that, I'll come over to the 1 hour. Now we need to identify our supply and demand. Now looking at this market here, where do we have a good supply and demand here? Here is a good supply. Here is a good demand level here. Here is a good demand level here. Why? Because if you look at this particular area here, after the market created this red candle, number one, this red candle is not bigger than this green candle, which means that the bearish candle is not bigger than the bullish candle. That is valid. Now let's take a look at after the two bullish candles that came out here, no other candle has been able to come as low as getting back inside this area again. So here is a valid demand level for us. So now after identifying the valid demand level, now there's another thing you need to identify known as your liquidity. Now here is it. Like if you take a look at this my image here, let me zoom it out. If you take a look at this image here, you have this place where I identified the dollar sign. This area here is known as the area of liquidity. Because the reason why it's called the area of liquidity is simply where a lot of traders are going to put their stop losses. Traders who got in, who decided to chase the market to keep their stop losses below there, because that is the last swing low before the market move upward. So over here they say identify liquidity must take out its own highs. So now your liquidity should be able to take out its own high. So for example, where's the candle that formed our liquidity? This red candle here. So here's our liquidity area here. This area here becomes our liquidity, because the moment the market break out of this area here by giving this big bullish candlestick, a lot of traders are going to chase the market by taking their buy orders here with their stop loss below here, and then they'll aim to the almighty for their take profits. So I don't know how I would address it. That's what I call it. They'll aim to the almighty for their take profit, which is not a bad setup, as everybody have their own trading approaches. So here is your liquidity level here. So over here, you mark it as your liquidity level. So over here, I'll just keep the dollar sign. Now, after this liquidity level, if you take a look at here, the market took out its own highs because the market went back upward. So this was the highest point the market created before giving us the liquidity command area. So you see, over here, the market has took out its own highs. So I'll put it with a check mark there. Now, let me show you a typical example of it, how it may look at times, because it might not always look like this. Let me look at for where it actually came out clearly so that you can see it. So you don't get carried away thinking all your liquidity levels will look the same. Okay, this one was for gold. Okay, now take a look at this scenario here. This scenario, you can see here is your liquidity. This is where the market pushed back downwards. So by the time the market tap at this high again, your liquidity got confirmed, which shows that here was your liquidity. Here was where the market confirmed that what it has taken out its own high. So now the liquidity is now a confirmed one. Because if the market hasn't taken out its own highs, it shows that what that is not a confirmed area of liquidity. Now take a look at this other one here again. Here is most of the ones you are going to spot in your textbook, and this sort of trade they come once in a while. Take a look at this one here. It was a solid one. Here was the liquidity. Here was the liquidity here. You can see the pullback the market created after it pushed from the supply area. In this case, here was our supply area. Here was a push out from it, and then the market eventually traced back over here and then come back and then tap at this area of liquidity. So that's the same thing we are doing here, but in this case here, it's actually a tighter one because we are on the 1 hour time frame. So now the next thing we are waiting for is that we are waiting for our entry confirmation. And the rules for waiting for our entry confirmation is simple. After identifying your supply and demand area, the next rule is simply identify your liquidity. Now you've identified your liquidity area as well, and it has taken out its own highs. Now wait for pullback to key level and wait for confirmation. So now what are we waiting for? We're waiting for this market to trade back into this area of demand before we take our trade. So for that, let me just play the bars faster. So now it's closer, so let me slow it down. Okay, good. Okay. So here the market tapped into the area, but we are not taking our trade here. The reason why we are not taking our trade here is that these two candles, if you look at these two candles carefully, no one need to tell you that these were news candles. So when I see news coming, and news is the reason why my trade got triggered, I often don't take it because I'm trading prop firms, and prop firms, they don't allow you to actually take trades when the result was generated by news. Like for example, if I set a trade here and it got triggered during the news, I violated my prop firm trading rules. So for that, I'm still going to hold. So over here now we have it that our liquidity has been marked out. So now after this news incident is over, I'm going to wait for the market to pull back into this area again before I'm going to look for my buying opportunity. So you can take that. If news give you the reason, you can take the trade. If news did not give you the reason, you can also take the trade. So all totally depends on you. But for me personally, based on my trading rules, once news is the reason why that trade got triggered, I just let it slide on until I get another confirmation. Now boom, here we have it. Now you can see that over here the market actually tap out of the area. The reason the market tap out was because they had another area of demand here that we didn't look into here. You can see we had other areas of demand as low as far back over here. You can see those are the ones that the market came to actually tap in. They were old zones as well. So taking this trade here is not still bad either, because you can see that the bullish momentum is still up and strong. So since it's the news incident, it's not bad taking. But if there was no news, let me say there was no news, and then the normal market circumstances, and then the market taps as low as this, then don't take it again. The reason why this market came as low as this by breaking out of this demand area is simply because of the news effect here. So since this news was created, another area of liquidity will be automatically created here by the market that the market needs to sweep before it will continue moving to the direction you are waiting for it to move into. And that is a frank truth you need to know. But if there was no news incident and then no such crazy candles that appears here, and then it was a normal market movement that gave you this break out of here, then don't take the trade again. But in this scenario, since it was caused by news, I'm actually going to take it. But from here now, we need to look for our entry. For that, let me cut back a little bit. Now, once the market come in here, when you are looking for your entry, we look at it. We look at the 15-minute time frame for it. Now they say, what is your entry confirmation? Wait for a candle to close in the direction of trade on the 15-minute time frame. So on the 15-minute time frame, we are waiting for a bullish candle to close above the demand area. So for that to fall to the 15-minute time frame. Now over here, you can even decide to say here the market has given you another, because here we have another supply again, another demand level again. So all totally depends on you. But in this case, I don't identify any area on the 15-minute time frame. I'm still more focused on the market going above this 1 hour level. So for that, let's see if we get a bullish close above the area. Okay, so here we get a bullish close above the area, and on the 15-minute time frame, you can see that we've gotten what we call a market shift again, because we had a pullback here, and then here we've gotten a market shift on the 15-minute time frame. So we have a market shift here, identified as MS. So this shows that what we have a good entry triggered already. So from here, I'm just going to set my entry. When I'm entering here, I'll enter here my stop loss below here. Yeah, but in most cases, you can decide to keep it below here. So since I'm entering on the hourly time frame, I'm definitely going to use a bigger stop loss position because I'm entering on a very higher time frame. So then our take profit here, our take profit, we can aim for this area here as our take profit 1. You can look forward to get that at this area here, or look forward to get that at this overall high here. So all totally depends on you, but taking your profit at this first high here is very important. Now here we have a solid 2.78. Now here's one thing I would like to let you in. when you use a big stop loss position like this, let me go back. When you use a big stop loss position like this, of how many pips? This is about 53 pips. Now, when I use a stop loss of this huge, the simple thing I do is that once the market move, like once this market move up to this level here, I'm going to reduce my stop loss to 30 pips, because my maximum stop loss I use is 30 pips for this sort of trade on the hourly time frame. So once the market tap to this area here, it shows that there's momentum to the buy side, so I'm going to reduce my stop loss. So for this, let's just see how the market plays on from here. So here you can see the market has done that, so I'm just going to reduce my stop loss to this level here. Now I'll keep it at 30 pips maximum. Exactly, I did not make any mistake. Now let's see how the market does from here if it gives us any take profit. Now let me just come over to the hourly time frame so that it will be a bit faster for us. Now as you can see, the market did what? It just gave us exactly what we wanted. As simple as that. Now the reason why I use the 30 pips stop loss maximum is that if the market tap at 30 pips after moving above this level, it shows that the downtrend is still strong. So let me show you some setups I have currently that I'm waiting for to play out. Here's one Australian dollar, US dollar. I'm waiting for this market to actually pull back to this top here. You can see this is the area of liquidity. I'm still waiting for the market to come sweep above before I get in. And then this one is GBP JPY. They also have a setup here. Okay, I have a setup. You can see here is the market shift. And then here is the area of liquidity here. You can see this low part here. The market has tapped around the area, but still hasn't given me any reason to look for any trading opportunity here. So in case it doesn't give me, I might then change depending on how the market continues the following day, here can become my new area of supply. But till now, I can't actually judge and see how the market moves first, because I've gotten my major shifts to the upside over here. That shows that I should be looking for a buying opportunity. So what I'm waiting for here is that, if possible, this market can actually sweep out here. If I'm to change my area of my entry point, then I might come here as my new demand level. That's if the market doesn't fall below here on time. Then I might come there and then wait for the market to sweep out this high here. You can see we have this supply here. If the market sweep out that supply, then here will become my new demand level. But until the market sweep out this supply area here, my demand level still stays at the lowest one. Because if the market is able to sweep out this high here, if the market is able to sweep out this high here, the probability of it coming back here is less, but the probability of it coming below here will be huge, because we're actually going to get a new stop loss, a new liquidity zone being printed over there. Sorry for that. So yeah, I have some quiet trade that I'm actually waiting for to play. This is GBP AUD. You see, I'm still waiting for it to actually give me a push into this area. Then here is GBP USD. You can see this GBP USD. This is my hourly setup, and here is my 15-minute setup. Let me go back to the 15 minutes. You can see here is a trade I took on the 15-minute time frame. You can see here is a trade. It's actually running live, as you can see. This one was taken on the 15-minute time frame. But my main setup for the day was actually the one at the very top over here. This was my main setup for the day, where the market was around here, but the market eventually fell way below here. So I had to change my bias by waiting for the market to come over here. Since it has given me a new break of structure here, it simply means that is likely to respect this area. So you can see, oh, I'm already in profit already. Nice one. So you can see here was the supply area. Let me zoom into it for you to see. You can see here we have a supply area. You can see this. Here is the bullish candle before the market started selling off. So the blue candles here are bearish. I'm sorry for that. The blue candles here are bullish, and then the white, a bit gray, are bearish. So here becomes my supply area. This blue candle here is my supply candle. You can see the market tapped into it. I wait for it to give me this push to the downside, and then I got in at the close of this candle here. let me just fit it into it. So yeah, the close of this candle is my entry. Even though the spread and all of that actually push the market a bit lower, because of the spread and that push the market a bit lower. So yep. Now when I'm marking over here, I have this 50% rule that I have here. So once this market trade up to this level here, I automatically push my stop loss from here to this 50 level mark that I have in my box. So this is simply the simple setup I trade, and you can see this trade is kind of playing out as I wanted it. So I'm just going to hold on to it and see how far it goes for me. So this one was taken on the 50-minute time frame, but I normally don't advise you trading on the 50-minute time frame because 50-minute time frames are quite risky. But whenever you take a setup from the hourly time frame, it has a higher probability of playing out. Like this one here, I have it set on the hourly time frame, and my take profit for this one here will be way below here. In case the market didn't respect here, then I'll be waiting for it to come over here. So over here, I took it on a 5K prop firm account. So I'm actually trying out prop firm. So during my prop firm reviews, I had to buy some prop firm for the tutorial. So that's why I took this trade over there. Now I'm waiting for it to actually play out. You can see I have an alert here. The reason why I have an alert here is simply because we have a support area here. So if the market reacts funnily around here, I might close out partial of the position and then let the rest of it run on. So that is simply all about it for this video. You can see these are the only pairs that I have right here. These are my forex pairs, and then these are the index pairs. So I'm currently trying to work out my way around the index markets. See, I also have a setup on index. So I'm not just trading only forex. I also have my setup on index. And so over here, here's my supply, my demand level as well. So yeah, I'm still waiting for this market to come give me a push into this area. Then I'm going to look for a buy opportunity. See, this is a very wide one. I have a solid 1:6 risk to reward here. And then in case the market decided not to come over here and then come back to retest the overall high that it has printed, you can see the market have this overall supply area here that the market hasn't come back to since Wednesday, May 2024. On this 22nd of May 2024, the market hasn't come back to it. So whenever the market comes in there, I might also be considering a sell opportunity from there as well. That will give me a solid 1:5.4. So supply and demand actually gives you good trading opportunities. You can see I had some setups here that the market didn't come back to. The market did not come back to any of these ones. So I'm now waiting for it to look at this new one that I have here. So this is simply all about it in this video. So for gold, I'm not actively trading gold currently. Yes, I'll let you know I'm not actively trading gold as the market is kind of funny. But I'm going to let you know if anything. I'm going to do tutorials on it. You can see for gold here, what I identified is flip zone. So what flip zone simply means is a support level now gradually turning to a resistance level. So that is what I mean by flip zone. And if you look at gold here as well, you have supply and demand swiftly played out for you as well. Here is a good supply level. You can see the market came back into it. And if you are taking a sell from here, if you are taking a sell from the close of this bearish candle, if you are taking a sell from the close of this bearish candle, your take profit could be here, and then your stop loss as usual above the box. You see you have the setup here, but I already had some setup that I was watching at closely, mostly that of GBP USD, so I didn't have to stress myself taking any further trades. So that's simply all about it in this video. If you find this video helpful, don't forget to smash that subscribe button, like this video, and tell me what you feel. So you can take a screenshot of the rules and then just apply them when you are back testing. And for any question you want to ask, my Telegram channel is widely open for you.